Okay, we're back here. Day 2, long-term assets, planned assets in particular, we're focused on first in Accounting 202. I want to review not the cost issues we talked about and the lump sum purchase problem. Those are not overly difficult, but I want to review depreciation, especially double declining balance method. And then we're going to try to cover the topic revenue versus capital expenditure, disposal of assets, natural resources, and goodwill. And we probably won't get that all done today. We'll do a little bit tomorrow along with our practice test. The integrity classes, this recording I'm doing, are working. They're up. I was hoping to get yesterday's class up last night, but the PC here that they're recorded on wasn't uploading well. It kind of went to sleep, and so you have to come back and get it to finish uploading. But they're all up now. Hopefully we'll get today's class available tonight so you can see it if you need to. Okay, back to depreciation. What do we need to know to figure the annual depreciation? What is depreciation? It's the amount of value that we're going to take from long-term assets that are depreciable. Some aren't, like land is not depreciable. But the value we take from those depreciable assets that we actually use up and wear out over time and use, how much we move every year, every fiscal period, and put over as an expense. In this environment, we need this information. What did you pay for it? What are the related costs you may have incurred to put the asset to its intended use, necessary and reasonable costs? Is there a salvage value for the equipment? Does it have value when it's all worn out as scrap? That's important because we don't want to depreciate or remove that value from the balance sheet and put over on the income statement. And then we need to know the useful life. This useful life is an industry term or amount. We get it from a third party. We get it from practice, how long it lasts for us in the usage that we're experienced with. But it's trade information that you can get if you're just starting out with an asset that you haven't used before. You also use the useful life in years in the double declining balance method. But in the units of production method, rather than useful life in years, it's the life in usage that's important. Like this truck will run 500,000 miles in its expected lifetime. This forklift will run 20,000 hours in its expected lifetime. So those are important ideas. Let's see how they work. Remember, we're going to study straight line, units of production, and double declining balance. We won't touch the tax method, makers, which is a form of accelerated depreciation similar to the double declining balance method. Okay, so let's move down here and look at straight line review. What did we deal with here? We deal with a computation of the amount that you want to depreciate over the useful life of the asset, which is cost minus salvage value. Salvage value could be zero. For like computer equipment, office equipment, copiers, faxes, no salvage value for those things. They wear out. Functionally, they're surpassed by technology generally very quickly in a few years. So those are examples of depreciable assets that don't have salvage value. But a big heavy hydraulic press in a shop, even if it's completely worn out, the metal and the parts have scrap value for other recycled uses. So you could or you could not have scrap value, salvage value, depending on what you're dealing with. And remember, a confusion that happens to students, and I understand why, because the terms are kind of loose. We're dealing with a thing called book value when we're talking about depreciated assets. And the book value is defined as the recorded cost. And so it's the debit up here in the equipment account, for example, minus the related credits for that equipment in accumulated depreciation. From those two numbers, we wind up with the book value, the weight of that asset on the balance sheet. Now remember, book value is a different thing than salvage value. It's not the same. However, at the end of a depreciation schedule, we very much expect book value to equal salvage value. That's the goal, to get it down to the salvage value. So keep those terms in mind and avoid confusion there. Straight line method, we use that depreciable amount example. this made-up problem here, $50,000 forklift, salvage value of 10. We only want to depreciate 40,000 of it, because even if it's worn out, it still has $10,000 value. Its useful life is given in years. We divide by 8. We discover annual depreciation is 5,000. We can prepare the entire depreciation schedule when we buy it. We can have it all set on a little spreadsheet, and we can see that accumulated every year gets bigger, bigger and bigger and bigger by the amount of annual depreciation. See, the numbers go like this. 5,000 accumulated plus the next year's 5,000 equals new accumulated of 10. So accumulated gets bigger. Book value over here gets smaller and smaller and smaller. Book value is simply the cost minus accumulated book value. See, it's declining, 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 declining until it winds right up at the salvage value, which we expect. Now, in a minute, we'll talk about we can change these numbers during the life of the asset, and we can change them with two things: extraordinary repairs, betterments, and we'll talk about what those are. But so this schedule may be amended by changes to the asset itself. Okay, that's a straight line schedule. Units production is kind of new. We didn't do that in Accounting 201, but here it is. You still want the depreciable amount. How much should I wear out over the life of the asset in the accounts? But instead of dividing by years, we divide by the life in terms of the units it can produce. Like, it can go 500,000 miles. It can run 20,000 hours. We get a number that we would then use with the actual incurrence of those units of production, or the accomplishment of those during a fiscal year. Like the forklift, still 40,000 in depreciable amount divided by the 20,000 hours in its useful life. It has an hour meter on the forklift. We know $2 are going to be depreciated for every hour that forklift runs. So you just send someone out to check the forklifts, record those hour meters. At the end of a fiscal year, they pull up a spreadsheet. They have last year's information. They can compute the hours run during the current year. They pull down in their spreadsheet the $2, and they can compute the annual depreciation. We can't do it ahead of time because we don't know what the hours run will be. But this is looking back at the end of all of those fiscal years for this forklift under units of production. We see annual depreciation runs all over the place. Even zero, theoretically, if it sat in the corner and didn't get used for a year for whatever reason. If you're sticking with the method, you're going to stick with the method, and you're going to wait until it actually runs before you depreciate it. Okay, so we can see that the end game, though, however, we're still at the end of those 20,000 hours. We still should get down to a book value equal to salvage value. Okay, so exercise or quick study 4, we don't have time to look at it, but quick study 4 is an example of units of production. Let's then move on to the third one. The third one in this is difficult because it's different. It's an oddball. It's called the double declining balance method. And this particular method was designed to cause you to have lots of depreciation in the early years and less in the later years. And in fact, you have the most depreciation the first year, a little less the second, a little less the third. Why would they want to do that? It's because they observe machines costing more to maintain toward the end of their life than they did in the beginning of their life. And since the total cost of ownership should be reasonable and pretty much constant theoretically, they decided if we match up an accelerated method with our heavy backloaded maintenance cost, we'll smooth out the total cost of ownership, and we think that's more reasonable. Instead of having cost of ownership spike way up at the end of it, it really should be more even, and we accomplish that by having higher depreciation in the beginning and lower at the end. That matches up with the maintenance cost better to be constant. So that's why they did it. They didn't do it just to create an accounting problem. They did it to answer a real-life situation. So how do you deal with double declining balance? Well, you follow the DDD DDB acronym. You say, I have to do some computations. The first one I'm going to do is the first D, which stands for double, which means you're going to multiply 2 times something. As it says right here, multiply 2 times the straight line rate. Well, we just did a straight line example, and they said, well, it's an 8-year useful life, but nobody said anything about a rate. What do you mean by rate? What they mean is what percentage of depreciation in a straight line scenario happens every year. So if the useful life is 8 years, 1/8 of that happens every year. That's what they mean by the rate. So once you understand that, then you also probably could figure out that the math to get the rate is simply put a 1 on top of the useful life in years. Put a 1 on top of the useful life in years. So we see that done here. Useful life is 8. 1 over 8 gives us the percentage that we're after, meaning every year some part of the total depreciable amount should get depreciated, right? In a straight line scenario. 1/8 should get depreciated every year in a straight line scenario. So the straight line rate is 12.5. In the DDB method, we're going to double that rate. That's where the 2 comes in. 2 times 12.5. 25%. Now once you have that number, 25%, that percentage, you're going to use it every year in your calculation of the annual depreciation for that depreciable asset. So once you have that, you keep it every year. You don't change it. It doesn't have to be recomputed. It's the same number every year. So back to our forklift, $50,000 purchase cost, $10,000 salvage value. Now here's where the first problem students have is they can't get started in double declining balance. Well, if you agree with me on those previous 2 slides, you can get started pretty quick now that you know the technique and know what the words mean. But here's where we have our other problem. They've been dealing with salvage value for straight line and units production by subtracting it from the cost. That's the first thing they do. Guess what? In double declining balance method, we don't do that. We ignore the salvage value initially. We don't ignore it long term. It has to be dealt with, but we don't consider it in our calculations initially. So we just take the cost, which turns out to be the book value of the asset in the first fiscal period. The book value is exactly the cost because there has been no depreciation recorded yet. And that, what they're talking about there is the second 2 letters in the acronym DDB. They're talking about the declining balance, DB. That's what they mean. They mean the book value of the asset. And so the very first year, the book value, or the declining balance, which hasn't declined yet, but that DB the first year is the cost, $50,000. So we grab our 25%, which we said we're going to use every calculation. We multiply it times the $50,000. We come up with first year depreciation, $12,500. Here it is right here. Now if you record that, you're going to credit accumulated depreciation on the balance sheet. You're going to debit depreciation expense in your adjustment. As soon as you do that, what happens to your book value of that asset? It drops by $12,500. As soon as it's recorded, you have a new book value which has declined. That's why they use the phrase declining balance. A new book value which has declined by that $12,500. It's going to be $37,500 to start your next fiscal year. So let's move to the end of the second fiscal year. What do you pull out? The same old 25% we said we're going to use every year. Multiply it times the new declining balance total, or the book value for the second year of 37, we get a little smaller number, $9,375. That is the second year depreciation. So that's how it's done. Most test questions ask you for the second or the third year. Why? They want you to go through the mechanism of how you compute the first year, because you can't compute the second until you compute the first. So you have to show you know how it really works. What are the mistakes? Subtracting salvage value to start. We don't do that in double declining balance. But we can't ignore salvage value. So if you pushed out a total schedule, which you can do when you buy it. You can have the computer punch out a schedule for double declining balance method. We can see how annual drops every year, accumulated grows every year, book value drops. But look down here. The book value at the end of year 5 was $11,865. If I multiplied this number here times 25%, I'm going to get a number that's a lot bigger than the number that's circled here, aren't I? I'm going to get, you know, half of 11 is 6,000. Half of that is much more than $1,865. Why is it just $1,865? That doesn't fit our model. Above all of these, 25% times that number gave us this number. 25% times that number gave us this number. Down here, that's not true. Why? Well, it's because they were running up to the salvage value. Look at here. They were getting close to salvage. If they would have used the same calculation, they would have driven the book value down below salvage. And that's how you deal with salvage value in the double declining balance method. You force the last entry in to cause the book value to equal salvage value. So where did they get 1,865? It's just the difference between these two numbers. Give me a little bit more depreciation to get me down from my $11,865 book value to the $10,000 I'm after, because I know that if I multiply by 25% like I have been, I'm going to force it too low. So that's how it's done. You just fix it at the end. There aren't many problems on the test that run into this issue, but it could happen to you. So watch for it and remember it. It's not difficult if you think about it a little bit and you know what your goal is in the long term. And it's also a good way to remember to ignore salvage value in the beginning, because you realize, or you're thinking, well, I may have to deal with it at the end, so that gives me comfort that it's correct to ignore it in the beginning. And that's how the double declining balance method works. Let's go look at this quick problem. I need you to consider a problem because I want you to be solid on this. So quick study 4 is a problem. I have it up here. Quick study 4, actually it's 6. Quick study 6 is the double declining balance method. I have it in front of you here, so could you kind of read that and see if you can do that quick computation? We're after 3 years worth, so I just want you to get started. Get started, that's the hard part. DDB, what are we after? The first D we're after is the double. Go find that doubled rate in this example. I'm sorry, 6. Quick study 6. Say again, what's the... In this problem here? Well, it turns out it's exactly the one we've been talking about in our example, because it's an 8-year straight line rate. So how do we get from 8, how do we get the rate? We put 1 on top of it. It's 1/8 every year. 1/8 is a straight line rate. Converted to a decimal fraction, 1/8 is 0.125, 12.5%. Okay? I'm going to pause my recording there if you're... Okay, let's go. I just wanted you to get started. Let's go take a peek at the solution. Quick study 6. Here it is. Remember they said salvage value is $100,000? What did we do with that number? We said I'm going to ignore it initially. I'm going to worry about it a little bit later. So we got our 25%. We know where that came from. 2 times 1/8 is 2/8, or 1/4, or 25%, times the book value. That is the cost in the first year, $300,000. Immediately, our book value drops down to $900,000. Shown there is 1.2 million minus 300. We get our second year. We then can move on, and there's some calculation there to show third year is cost, 1.2 minus first year depreciation minus second year depreciation times 0.125. That 168,750, the asterisk there says, just to assure you now, you didn't go below salvage. You're still okay. So this is a great example of the kind of presentation you're going to see on the test to do a DDB question. And they are, if you don't get into them in the detail we did here, they are puzzling and frustrating at times, but they're not hard once you have that method understood and what they're trying to accomplish. Yeah, they gave the number was 100,000, I think. Yeah. Yes. Sure. Oh, absolutely. The question was, will they tell you in a test question what method you have to use? And they have to. Absolutely. See, back here, they gave us in the problem this number. Whenever you give accounting students a number, they want to use it. We feel compelled to use it. So you have to make the decision, when do you use it? In the DDB method, we use it at the end. We keep checking to make sure we didn't go below it. If we did go below it, we revise the last year's depreciation so we hit book value equal to salvage value in the last year. Sure. Back to the solution. That's what it looks like. See, we're still in that last number, 168. We're still there. That's the depreciation for the year computed. Yeah, that's the reduction in value. The number shown there. Okay, so we're okay with depreciation. I'm going to move on to revenue versus capital expenditures. Let me pause for a minute to set the file.